Hello, everyone. Great to see you this evening. My name is Donato Callahan, Timberview Capital CFO, and tonight is the fourth installment of our How to Catch a Bad Deal webinar series. We started with multifamily, went to oil and gas, talked about triple net leases, and tonight we are discussing short-term rentals and boutique hotels with my co-host and guest host this evening, Rafa Loza.
Hey guys, pleasure to be here.
All right. Just like every part of our How to Catch a Bad Deal series, this is purely educational. The goal of this series is to help you, our audience members, learn how to assess risk in different types of asset classes. So whether you're investing with us here at Timberview Capital or elsewhere, you know exactly which questions to ask and know exactly how to step into or stay away from deals on an asset class basis. What we're going to cover this evening is background information about short-term rentals and boutique hotels. We're going to leverage Rafa's extensive experience in the short-term rental and boutique hotel market to talk about some specific case studies that he's either invested in or chosen not to invest in. And we're going to give you guys some actual questions you can take to the next opportunity you're looking to invest in to ascertain whether or not it makes sense for you to participate. So at the back end, we'll have about 15 minutes of Q&A. We'll get a chance to ask me, and more importantly, Rafa questions about different short-term rentals and boutique hotels and what you may need to know before you hop into your next deal. And we'll let you know some opportunities that you guys can pursue or go have questions with the sponsors on if you want to pursue the short-term rental or boutique hotel investment space. So without further ado, let's hop right in. Oh, last moment. If you have any questions over the course of tonight's presentation, please put them in the chat or the Q&A. We'll do our best to answer those questions as time goes on. If we do not get to the question during the course of the main 45 minutes of content, we'll answer it in the back 15 minutes Q&A. All right. Thank you very much. So let's talk about it. Short-term rentals and boutique hotels. Very commonly, they're thought of as both the residential and the commercial side of the same overall asset class, being short-term rentals or nightly rentals. But there are very specific and important distinctions between the two. On the left-hand side of the column, we're going to go ahead and talk about short-term rentals. What you typically are owning in a short-term rental is a house or a condo or a small multifamily building in a residential zone, plus, depending on your locale, a revocable local operating permit. Think about it like a single-family home or a condo in an apartment building or luxury scrawling facilities in areas around Arizona, California, and other luxury destinations that you rent out to tourists. Now, what drives revenue in a short-term rental is almost exclusively the nightly rate times occupancy. It's generally very seasonal, it's very leisure-heavy demand curve, and it's sold through different platforms like Airbnb, VRBO, and so on and so forth. The dominant risk in the short-term rental market is regulatory. I cannot stress this enough, and we'll have Rafa talk a little bit about this. But over the course of 2021 to 2026, many markets around the United States adopted different regulations, which seemingly overnight completely changed what Airbnb operators or short-term rental operators could do, what they couldn't do, and how profitable their operations were. Rafa, can you speak a little bit about a real-world example where you saw either yourself or other operators in the short-term rental space see a regulatory change and what that impact had on a portfolio? Rafa, we can't quite hear you. I mean, have an audio. That's a big short-term rental trying to keep us quiet, right? We want to spread the truth, and we're getting shut down by the man. Go ahead one more time, Rafa. No problem. So while he's going ahead and taking care of his audio, we'll have him come on in just a hot second. But when you are talking about the structure of these real estate classes for short-term rentals, normally because most people can buy a piece of real estate or buy a condo or buy an apartment, you generally have direct ownership. You might own these through a small LLC, unless you're doing an arbitrage-based business, which we'll talk a little bit more about what arbitrage is soon. But in an arbitrage situation, you don't actually own the real estate. You are essentially signing a lease to the real estate. So you go to a property owner, you lease it from them, and then you turn around and put that property on Airbnb or VRBO.
Yep. Can you hear me now? Am I back?
Yep, yep, we're good to go.
Yeah, sorry about that, guys. I've been having internet outages all day at the house here. This heat's messing stuff up. But yeah, I want to touch back a little bit on the regulations that you touched on because this is a huge deal. Talking about how bad deal. And number one thing now that I tell everybody, as you guys know, I obviously coach people and walk people through finding their short-term rentals, is regulations is the most important thing to be looking at. So I'm going to give you guys a perfect example. Obviously, I'm not ashamed to say it. Everybody's talked about it, but I used to always tell people to wherever you get approved to open a short-term rental, go ahead and do it, and then you can figure out the regulations later if it's in a market that didn't say that for two reasons. Number one, you fast. Number two, you're going to save a lot of money and make a lot of money because you're not paying out of the on the back end. Yeah.
So yeah, what did I tell you guys, right? Big short-term rental is so afraid of our understanding of this market, they're trying to shut Rafa down. We'll go ahead and have him back as soon as that California heat abides and he's able to keep walking through with us. But what he's going to refer to is the fact that he had at one point, I think, over 130 different short-term rentals across different markets. And in a very short period of time, he saw different changes in California and other Western state regulatory environments seemingly overnight shut down a business that was making hundreds of thousands of dollars a month in revenues for his organization. And so he had to pivot, switch, look at different markets, look at different opportunities, and allowed him to restructure and re-understand how to still operate dozens and dozens of successful Airbnbs, even in markets where regulations have shifted. So how we see things financed in the short-term rental space. Again, if you're buying it yourself, it could be a conventional loan, a DSCR residential loan, and normally it's underwritten to the property. And what kills the exits on these types of deals are generally permits that don't transfer, regulatory changes, or the costs that come on top of the actual mortgage. So things like management, cleaning services, and so on and so forth. On the boutique
Got it.
hotel side, completely different. Okay, completely different beast. Boutique hotels, either independently operated or part of a franchise network, are an operating business. You have a building, you have FF&E inventory, right? You have staff, you have a brand license oftentimes. And your RevPAR or revenue per available rental across leisure, corporate, group demand is all measured against a defined competitive set. Think about it like going to looking at hotels in Miami. There are hundreds of options, all vying for a set number of tourists, all displaying what? The price. So you're constantly having to adjust up and down your pricing to make it work. And the dominant risk is operational, right? You can have a great hotel, but if your cleaners don't come in and they don't turn the units, the second that someone checks into that hotel, it can completely turn off the experience. If the front desk person isn't doing their work to have check people in appropriately, if the ice machine is broken, so on and so forth, the operations can make or break your whole overall deal. And because NOI can swing pretty significantly on management execution, and there's no long-term tenants necessarily in play that are giving you a baseline of revenue, it can be a little bit tougher and require a lot more operational involvement to be successful. Normally, those types of deals are operated on a Reg D syndication, 506B, 506C fund structure. They're normally not just something you can buy yourself. And generally speaking, you're not getting a usual residential loan for this. You're generally going to CMBS loan, bank debt, or other types of third-party financing on the commercial lending space, generally getting higher interest rates. And the lesser known you are, the worse your rates are going to be. So it's definitely a step up in terms of securing those loans. And honestly, what kills the exits on those boutique hotels is poor operating in place or comp set that were never real. Rafa, do we have you back?
Yeah, can you hear me?
We got him. Okay.
All
Letting you
right.
know that we persevere. Go for it.
Yeah, sorry about that. Again, yeah, I don't know. We're having really bad outages in my area right now, so I'm just gonna do it off my cell phone. But I'll go back a little bit on the regulations if you want me to.
Yeah, that'd be great. Please.
Yeah, so I don't know how much you heard the last time before I disconnected here, but basically, I used to tell people to go into any market, even if it was unregulated, and I actually preferred unregulated markets when this first started. Mind you, guys, I started doing this back in 2017, so there wasn't as heavy regulations back then as there are now. And I used to tell people to go into these markets because of two reasons. Number one, it would make them a lot of money. They can get up and running fast because there was no fees, taxes, all that stuff, permits that you'd have to pay on the backside. And so you'd pocket a whole lot more money and you'd be able to start running extremely fast. Unfortunately, at that point, what happens over time after short-term rentals got really popular, a lot of unprofessional hosts started getting into the short-term rental space, started causing a lot of problems in a lot of cities, a lot of regulations started coming to play. And so you'd have the people throwing parties, the guests throwing parties, and then because some of these hosts didn't have security systems or have the right way to manage or the right team or how to put the right systems in place to avoid all those type of deals. And so it gave a lot of people the bad name of Airbnb, right? There's always that sour taste in every municipality because they thought Airbnb would mean people would show up to their neighborhoods and cause a lot of problems. And so I was actually in a market where I had close to 40 something short term rentals. So, to give you guys context, these were arbitrage, and we'll talk on arbitrage in a little bit. I'll tell you guys my story on how I started there. But we ended up closing a total of between me and the group of people that I had in my network, my brother, family members that I've helped get started in short term rentals, we ended up closing close to 70 locations. And it was brutal. That was because one day the city decided that they were just going to ban short-term rentals overnight. Now, granted, that's not legal. There was a lot of legal repercussions and things that happened to the city. So a lot of hosts got together. They sued the city. The city ended up losing. So now they've become available again. However, at that point, the damage was done. And so one of the biggest risks, and the first thing I will always tell everybody, and I hope everybody listening to this truly takes this home by understanding the fact that I had to close 76 locations. It hurt our company really bad. I mean, we had to. But thankfully, I have a lot of different locations in different markets and really budget friendly and really high end luxury short term rentals, where this specific situation, the city came in and said, "Hey, we don't want short term rentals," and so we ended up closing a bunch down. But my good ones ended up covering our costs. But we did have to pivot and make a lot of changes. Now, again, this was in a town that did not have short-term rentals prior. I want to make that very clear. I don't want people getting scared. This was a town that was what I would call the Wild West. They had no short-term rentals. They said, do whatever you want. And they actually set up a town hall meeting for council to get together and put regulations in place. Meaning they were going to get together at a town hall meeting and say, all right, we're going to pass a permit. You're going to have to pay taxes. You can only, whatever rules and regulations they put on. A lot of cities, it's like you can only have one within 150 feet of another. They have to notify neighbors. Nobody can be complaining. You have to pay for a permit. You have to get a business license. You have to pay your 10 or 12 or 15% taxes, and then they put a cap. So they'll say something like there can only be 1,000 short-term rental permits, or they say every 3 months a certain cap so that they're not flooding the market quickly. And so this town didn't have that. And so I had a lot. I've built a lot of locations. And then when we get together to the town hall meeting, they pulled a fastball, a fast one on us. And they said, hey, we're not putting regulations. We're going to ban them. We're sorry. Good luck. And so, again, as you guys know, it was terrible. Luckily, a lot of us got together and the city got in trouble and now we're operating again. However, you can imagine the headache. So, lesson there, I never go into a market that does not have regulations. And by regulations, I mean some sort of standard on how we can operate. I know what permit I need to get, number one. I know the location where I can operate, what zones, what city areas, what neighborhoods are good, which ones are not. I'll know things like the level of permits. So, for example, in San Diego, there's a level of permits. If you're near the water, it's a certain level. If you're a mile and a half from the water, it's a different level. And then if you're in a residential zone, it's a different level. So you can know which type of permit you can do and what you're allowed to do and how much in taxes and type of fees you're going to have to be paying for those. And then you can operate without stress because you know for a fact that you're allowed to do short-term rentals and run your business in that market. So, Donato, I know that was a lot, but I want to really make sure everybody really understands the risks and really understands how to avoid that and what to really look for. And guys, really quick too, when you're looking for this, it's a simple fix. Type in the city on Google. So, for example, just type in what city name, short-term rental ordinance, and then go to the actual city website. Don't go to a third-party blog that thinks they know what they're doing. And if you're confused in any way, call up the town, call up the zoning division, call up the most of these guys have a short-term rental division, call them up and just ask for clarifying points on what you can and cannot do in the market.
Perfect. And to be clear, everyone as well, Rafa still manages and owns dozens and dozens and dozens and dozens of short-term
Oh yeah.
rentals. They didn't get him out of the game, but it changes how the game is played. And
As
so
not,
for everyone here,
yeah,
yeah, go ahead.
Donato, really, I'm sorry not to cut you off. And to clarify, a lot of those ended up becoming midterm rentals. And now that we're allowed to operate again, a lot of them are slowly coming back as short-term rentals. But that does, yeah, I want to make that super clear. A lot of those units, all we did was pivot, and a lot of them we ended up taking our furniture and putting into bigger homes and actually moving in different directions. So now we're doing the development stuff in markets where we know we can actually operate.
Awesome. And so for everyone here, you can do very well with these. And the whole point, again, I say this every time we do How to Catch a Bad Deal. The point of these webinars is not to dissuade you from any one asset class. In fact, it's meant to encourage you to pursue these asset classes armed with the appropriate knowledge. That's what we're trying to do here. So now let's go ahead and dive in to our first subset this evening of short-term rentals and get into it. So let's talk about where these deals break. First off, permit. Clearly, permit is the asset. In many jurisdictions, a short-term rental license has different rules, as Rafa just pointed out, has different levels. It can be at the owner level, it could be at the property level, and oftentimes they do not convey at closing. So just because the last guy had a permit doesn't mean you're going to get a permit if you invest in one of these. And cash flowing properties can swap from using short-term rentals numbers to having to become a long-term rental number. So before you pursue an opportunity, you need to understand what not only the type of permits you have, but what happens when ownership of an asset changes. Next, HOAs, associations where can be in locations where the city may not have a regulation, but HOAs could prohibit short-term rentals even when the municipality expressly permits them. So for your specific unit, you need to understand what the covenants and resolutions are and understand that you may have to play by another additional set of rules that other people don't because of the specific area of where you're at in the specific market is. So it's why it's very common for short-term rental investors to simply say no HOAs. We're not doing it. Or they take over the entire thing and they buy everything or they lease everything and they take control of the HOA. So you kind of got to go all or nothing with these approaches here. Next up, annual averages. So there are a lot of great prop tech or property technology platforms out there like AirDNA and other types of softwares that are all about giving you numbers on short-term rentals. And 2026 US short-term rental average occupancy is 57.4%, right? Across the nation. It is easy to think, okay, 57%, I'll just round that to 60%. And that means that 60% of every month I'll have people. So that is, on a given month, what is that going to be? 18 days a month, I can plan on that. That's not necessarily the case. Sometimes 57 or 60% occupancy means you are chock full every single day, booked, 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 booked for 4 months straight. And then you have no one for 4 months straight. And so you averaged maybe 50 or 60%. But if you make all your cash flow in a specific part of the year, and then you don't have reserves or other forms of income to carry those properties in the down season, all of a sudden that 60% occupancy starts to get a lot more precarious. Next up, and we're going to kick it to Rafa here in a hot second, arbitraging does not mean ownership. In a lease-based short-term rental business, you don't actually own the building, and you have to have a partnership with the person who actually owns the asset. Where now, not only you're managing the short-term rentals rules, you're managing the lease rule that you have turned around. So, Rafa, can you quickly walk us through what is short-term rental arbitrage as a base?
Yeah, absolutely. So, for those of you guys that don't know my story, when I started doing short-term rentals in 2017, I couldn't afford to buy a property in Southern California to run either as a long-term rental or as a short-term rental. And so what I did is I started with a strategy called rental arbitrage. And rental arbitrage basically means you can rent out other people's property as a long-term tenant with a 12-month lease, and then you furnish it, set it up, go do everything you need to do to get it running as a short-term rental, and then go live on websites like Airbnb, VRBO, and you make a spread on the difference. So for example, in 2017, I rented a two-bedroom apartment. At the time, the rent was about $1,900, and I put in 10 grand to get it furnished and set up. And then I rented that out. At that time, it was fantastic. I think it was like $6,000 for the month. So I made a very big spread on cash flow from the rent I paid and expenses and the difference that charged people on a nightly basis. So I would make more money because I'm charging it as a short term, 1 to 2 nights per stay. Now, that's a fantastic way to get into short term rentals if, number one, you don't have money to start. And number two, if you're trying to learn the game, and without actually making a giant investment or not going into a place where you don't know how you're going to be performing. That's exactly what arbitrage was. Now, the reason I did that again was because I didn't have the funds, and number two, because after I got really good at it, it was very scalable. We would convert apartment complexes into little hotels where we would rent the entire complex out and then convert them into short-term and midterm rentals and get them up and running very, very quickly. So with that, I scaled significantly. I learned the business. I built the systems, the processes, scaled out the team, trained the team, and then we were able to seamlessly flow into the boutique hotel space because of that experience. And we were able to get into the purchasing because then we were generating enough cash flow from those units to be able to start buying assets.
Awesome. And one question that typically comes up with audience members when looking at either investing in an arbitrage fund or doing arbitrage themselves is why would a landlord do that? I do it, meaning I don't arbitrage. I have units that I own that I lease to people like Rafa, who then turn around and put them on short-term rental. And why do I do it? Because they clean them consistently, and I don't have to worry about it. They sign long leases. I don't think about it. It's great. So they can be really great setups, but arbitrage is you're foregoing the investment and the equity growth of an asset in exchange for low upfront costs and getting into cash flow quickly. Not a problem, but just a feature of that specific model, which leads me right into my step number five, which is gross revenue does not equal cash flow. Cleaning, turnover, supply reimbursements, and supply refreshments, platform commissions, pricing software, furnishing costs, occupancy taxes, and reserves all take away from that nice big thick fat top line revenue number. And property management, if you think about the residential space, oftentimes people have the number 10% in their minds, where if I hire a property manager, it costs me 10%. In the short-term rental space, you're going to be 20 to 25%, maybe even more. It gets a lot
Yep.
more work. You then also have cleaners. You can manage people coming in. If someone, uses toilet paper or paper towels, you got to pay to refresh those, right? All these things come into play. So it's not just I'll Airbnb it out. It's a specific mathematical formula on can you afford to get the property debt service, insurance, taxes, utilities, and then also maintain all the things it takes to create a hospitality experience. And then finally, supply and demand have converged. So AirDNA projects listings and demand both growing around 2.7% this year in 2026, with RevPAR, again, revenue per available rental, growth of about 2.9%, almost entirely coming from rate increases. So a model that assumes that both your rates are going to increase and occupancy is going to increase at the same time in that market is not always a reliable assumption to make. All right, so now let's talk about the regulatory map. So, as an example, different markets have different levels. New York City, under local law 18, entire unit stays under 30 days are effectively prohibited in most buildings. And they've issued over $70 million in fines for people who broke those rules. Which is why, for example, Rafa did his transition from short term rentals to mid term rentals in some units where now your minimum stay is 30 days or longer. Hawaii is also a very restrictive market for these places, with short-term rentals very largely confined to resort and visitor zones. They are very stringent on their caps. When you go to Hawaii, so I was there back in October of last year, you can drive around areas downtown by the beach, and you'll find massive signs everywhere about only X many Airbnbs allowed. It'll say property owner at 123 Main Street is putting in an Airbnb. Here's the court date. You can come and tell us how much you don't want that to happen. It is very, very antagonistic to Airbnb operators for those in that market. Other places like Texas have proposed bans, but again, like Mark Raffet said, a lot of operators get together and do class action lawsuits. Those things get repealed in Texas. Then you other have states like in California, and other spots across the United States, like in Texas, Arizona, Idaho, Indiana, and so on and so forth, where there's permission, but it could be changing, and ultimately, you don't know. Which honestly comes back to why Rafa talked about it's better to play by some set of rules than by no rules. Because once they put their line in the sand of where the rules are, you can actually start to make a plan around them. But going into somewhere where there's no limits, no registration, no regulation, you have no sandbox to play in, you don't know what's going to come down the pipeline. So now let's talk a little bit about the supply wave. So in 2020, 2021, 2022, the US short-term rental listing growth in terms of number of platforms or number of rentals listed grew 20% for almost a couple of years there, year over year, just boom, 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 boom. Then you get to 2025, and that's down to just under 5%. And then 2026 is now under 3%, meaning that we saw a ton of people move into the short-term rental market very quickly. And now fewer and fewer people are coming into the space and it's stabilizing and it's digesting. And just like everything, no matter what's hot at a given moment in time, there are people who treat it seriously and there are people who don't. And that's okay. But when you have a lot of people and you have a lot of supply coming in, that has a negative downward impact on pricing and occupancy. And so you have to be able to pivot appropriately in terms of your price point, in terms of the condition, in terms of your location, in terms of your amenities, or what you're doing to attract people, which means ultimately that this is a business. It's not a hobby. And so when people are pursuing short-term rentals, it can be very easy to mistake it for something you can just pay attention to once in a while and be a set it and forget it, when it's very much a hospitality-based business. So when you're modeling your short-term rentals and you're looking at opportunities, you need to be very clear when you're looking at underwriting around what does occupancy look like for that given year? What does rate look like for that given year? Are you expecting, or is that operator investing into expecting those things to continue to climb from where they've been previously? They need them to simply stay flat, and so on and so forth. Rafa, can you talk a little bit about when you saw a lot of different properties coming on the market and you had to pivot? Can you give a few examples of what you saw operators do who took their businesses seriously in order to survive this incoming wave of supply and set themselves apart from maybe other operators and other properties?
Yeah, absolutely. So, after the COVID boom, when everybody was getting out, it was a very, very hot investment. Everybody, I mean, literally anybody listening to this call could have bought a house anywhere, put a couch in it, a simple frame on the wall, nothing special, and it would be booked out all the time because people just wanted to get out and travel. And plus, all those free checks were coming out. And so, what that did is why you see that flux of supply go up so high because so many people got into it and there was just a huge influx of people starting short-term rentals in any market. And that's actually what led to the regulation boom, I call it. And so once that stabilized, like every market, right, they call it the Airbnb bubble, it bursted. And a lot of people stopped traveling. The states opened up. You could travel abroad. And a lot of people stopped traveling inside the United States, and everything started going downhill. So around the end of 2024 and in 2025, that's when a lot of everything started stabilizing significantly. Everything went back to what I say pre-COVID days, my 2019, 2018 days of the operator that was running short-term rentals back then. And so a few things happened there. The people that got into the short term rental space that were self managing, they all fell off. I want to say 90% of these people fell off. They ended up selling the property, a lot of them at a loss, unfortunately, or they ended up converting these things to long term rentals, or a lot of people have now pivoted to midterm rentals. That's actually the new hot one right now is midterm rentals. And I see the same thing happening there. The market's flooding with midterm rentals as it was with short term rentals because a lot of people were underwater and they need to pivot. And a lot of people, unfortunately, during the boom, bought properties extremely overpriced, underwriting with short-term rental numbers, not underwriting with, hey, can this work as a long-term rental? Hey, can this work as a midterm rental? Can this work as a long-term furnished rental? They all demand different rates. And so those people that were not professional operators running this as a business have unfortunately lost a lot of money and are now pivoting to different type of strategies or have ended up selling the property itself. Now, for the people that did stay and that were running it professionally, I obviously raised my hand for that one because I've been doing this for a long time. So I saw how it was before, I saw how it was after, and I saw how it was during the boom, the post-COVID boom. And so in order for us to stay afloat, a lot of things have to happen to change. You have to, number one, stand out in your market. What are you doing differently to stay above the influx of supply? What am I doing differently? Well, I call it the amenities war. When that happened, a lot of people started throwing a ton of stuff in their properties, which is why I actually got into the luxury space because I realized how well the luxury plus the amenity side of short-term rentals, how well it was performing. And so people started, I mean, you could literally compete. It started with, I'll give you as a perfect example. It was like the hammocks. Everybody had hammocks. And then it was the hot tub. Everybody had to have a hot tub. And if you didn't have a hot tub, you were not getting booked. And then from hot tub, it went to the saunas. And everybody started putting saunas in their properties. And it was just one amenity after the other, after the other. Right now, the hot ones are pickleball courts. Everybody puts pickleball courts. If you're not putting a pickleball court in your property, you're already falling behind. There's a new trend I already see coming out, and people are doing the game rooms. But now, on top of that, the game rooms with the putt putt inside. So they'll carpet the entire game room with turf, and then you can be in the game room and simply playing putt putt in the game room itself. So everybody's always competing with amenities. And so, how do you stay above the next person? You got to make sure that you're providing a better experience and a better place for them to enjoy. It's no longer people looking for a simple place to stay. It's now an experience of what they're going to get and enjoy during their time, during their travels. So, for example, I always give this here. If I were to book by myself with my fiance, I won't book an Airbnb just for a place to stay anymore. For $150 to $200 a night, I'd much rather go to a hotel with the pool, with the restaurant, with the bar downstairs where I can enjoy myself. My room is made every day. I'm having fun. The service is there. I have valet, all of that. Why would I pay somebody $150 to $200 for just a place to sleep with Netflix maybe provided and nothing else? It just doesn't make sense. So when you're looking at those things, you really got to compare in your market and go, okay, what's working in this market, and how can I put that towards my property? Whenever I underwrite deals for anybody, and I've done it for a couple members in the group here, they send me properties, and I go, okay, let's look at your property. Let's pull the data from that one market and see what the 1% in that market is doing and how they're doing it. And I immediately know when I pull up data and I pull up all these comps what market and what the number in that market and what the number one property is instantly, because I see it. The decor is amazing. They've put time and effort to make the decor just very special, and it always aligns with something in that market. For example, in Green Bay, you walk in, the garage has Green Bay Packers all over the place. It's green. There's football. You got the all the football theme stuff. I mean, you got the giant screen so you can watch the games. Everything is tailored to that customer. You go into Big Bear here in California, and you got everything in there with the jacuzzi, the sauna, the outdoor. They still do tennis courts there if you can fit them. You've got the garage room with the big mural of like some sort of Big Bear related activity. All of that fun stuff. They do an Oktoberfest every year, so a lot of these places are tailored for Oktoberfest, and so they put stuff in there. The Stein glasses, all of that fun stuff. And so you got to figure out exactly what it is in that market that's really going to stand out. I know a guy who actually puts a full 9 golf courses in his backyard to just be above and beyond. I mean, that will 100% make you stand out. So the professional operators, to tie it all together, are the people that take this serious as a business because they know how to cash flow. Now, for a lot of you guys looking at this, you go, well, I'm not going to be a professional business owner in short-term rentals. I just want it for the short-term rental loophole, or I just want it for a side investment because I need to park my money somewhere and I know I can take advantage. That's totally okay. The only thing I will tell you is to find the management company that knows everything I'm talking about now. If you ask them, hey, what's the 1% property doing out there? And they can't answer that question, you might want to rethink who you're handing your property to. If they tell you, hey, we're going to charge you 25%, but they don't know how they're going to price and what the market occupancy is for the year, you might want to rethink who you're handing your property to. You want to make sure that the person that you're going to hand the property to be able to manage, and you're going to pay a hefty fee, knows all of the levers that are being pulled in that market to be successful. Donato alluded to the average market occupancy for the year. What do I need to have saved for the year so that on the slow season, I'm not having to come out of pocket? Right? I always tell everybody, look, if I'm going to manage it for you, you're not taking a single dollar for a minimum of 3 months. All that money needs to build up. We need to have 3 months worth of expenses sitting in the accounts at all times, because I don't want you being upset at me when it's slow season and there's not enough funds to cover your costs to operate this property. And everybody's like, oh, well, that's smart. Well, because we average for the year. We know that during the year, I'm going to have a certain number coming in, and I need to make sure that on certain months, I'm going to have a certain amount of money going out, and I need to make sure that on those months, I'm able to cover it without having to come out of pocket. So hopefully that all makes sense. I mean, I can go on this forever, Donato, but I'll stop there and let you continue.
Thank you very much. That was great. All right. So now let's talk about what happens when you're an investor who doesn't ask these questions going into a short-term rental fund. Well, for example, we have the Lefevre Matson and K Club Resort Marina affecting over 1,400 and 200 investors, respectively. And I want to point out that in the Cape Club Resort Marina operation, that was pre 2019, 2020, 2021. But they were sold a variety of five-star destination resorts, short-term rentals, boutique hotels that ended up being a Ponzi scheme. Didn't work. That's an operation. They sold, interest in residential commercial real estate partnerships to church congregants, if you can believe that, for 15 years, who thought they were getting in as effective short-term rental investors. That didn't happen. Over $46 million wiped out. And then you have uh, Equi Alt LLC, who had over 170 million across 1,100 investors, do the same thing with fraudulent unregistered securities offerings in the short-term rental space. So I want to be clear. Oftentimes, these funds are pitched as a complete done-for-you Airbnb and rental arbitrage program. They can be sold as passive income. And granted, these types of investments can have passive income. That is true. Short-term rental funds do work. You can buy them. You can get a boutique hotels. Absolutely correct. But if you don't know how to answer or ask the questions that Rafa has talked about or we're talking about, your investment into one of these can fall apart very, very quickly. From ADRs, average daily rates, to occupancy trends, to permitting, to regulations, and to all the different costs associated, you need to understand what you're actually participating in and if you're okay with that level of risk. So, how do you assess that risk? Here's what these questions sound like. For example, when you ask a sponsor operator about permit and entitlement, what they should be able to tell you is no problem. Here's our permit number, the type of permit we have, the type of permit we're required to have, and confirmation from the city that shows that we have the legislation that we need to be able, or a regulation that we need to be able to have in writing. How about regulatory reversal? Someone like Rafa could say, hey, here's exactly what the city of Los Angeles or San Diego is doing for their current legislation. Here's what we're tracking. Here's what we know is coming out of the pipeline. And if this does happen, here's what we'll do instead. Great. Seasonality. Here's what the last 24 months of occupancy and ADR, average daily rate, have looked like by month from the actual property, not a market average. Here's what we've been doing so you can see what we're basing our assumptions off of. And how realistic are the expenses, Mr. and Mrs. Operator? Here's all the different expenses we've had running this property, from cleaning, supplies, commissions, software, debt, taxes, insurance, utilities, and so on and so forth. Here's all the real costs associated with it. And your reserves. Do they have reserves? Just like Rafa talked about. Yes, we have 3 months of operating reserves per unit funded at close. We bring those things together. We make sure we have those reserves to get care of. And what happens if the rules change? It's like Rafa talked about. Don't buy and get into properties that only work as a short-term rental in a market that's not designed for it. Be able to understand what it takes and can you survive if you have to rent it as a long-term rental or a mid-term rental and have other ways to exit that asset. So I'll let you guys go ahead and grab a photo of this slide so we can keep on track with our content this evening. This is a basic list of questions that you can ask the next operator or presentation host that is trying to talk to you about different short-term rental or arbitrage opportunities. I recommend you take a photo of this. Again, this PowerPoint and this recording will be sent out afterwards. This is a great guideline on what you can be asking before you choose to participate, including things like, is a permit or a license required? What happens if we have to turn this as a long-term rental? What are the other costs outside of the cleaning costs? What does this property's revenue and expenses look like over the last 2 years? And you talk about if this is an arbitrage, can you show me the terms of the lease? And overall, what are our assumptions based off of? But this is a great framework for getting through these questions and being able to make a confident assessment and if you want to pursue or not. Finally, really quickly on what these different terms are, because we use a couple of different jargon this evening. ADR, average daily rate, it is the room revenue divided by the nights sold. Occupancy is simply how many nights you sold divided by the nights available. RevPAR, revenue per available rental, is the average daily rate multiplied by the occupancy. Gross versus net, again, gross booking revenue is the top line. Net is what reaches you after the very end of the costs. And permanent short-term rental license is just a local operating type. A quick little bit of vocab and different terms you'll hear tossed around the short-term rental space. Now let's transition to our part two, our boutique hotels. So, where do boutique hotels differ? Now, think about you're going on vacation and you're checking into a Hilton or a Marriott or a mom and pop kind of 13 key bed and breakfast, right? Those are all boutique hotels. Some are with national operators, some are independently owned. And a big difference, guys, when you're talking about boutique hotels in the hotel industry, instead of talking about doors or units, like a multifamily operator might talk about it, they talk about it in terms of keys. So you want to speak the language, talk about how many keys do you have, or it's a 20 key property. So, how do these deals break? First off, boutique hotels are an operating business. You have inventory nightly, you've staff, your NOI can swing up and down on execution alone. It is a large scale business. Next up, with large scale businesses and larger properties, you have CapEx. That could be roof replacements. That could be multiple unit turns. That could be a tourist who turned the bathtub on and left it on all night. Now you've got 3 floors of plumbing and flooring you have to redo because the water sank through. Not fun. Oftentimes, we have to make sure that the CapEx requirements are not being left off because generally speaking, it's easy to forget that when we travel, we generally, I'm not saying everybody, but we generally don't treat places we're traveling and staying in as nice as our own home because we don't have the consequences of dealing with the damage we're doing. If you hurt your own house, you have to pay to get it fixed. You have to live with it, you have to deal with it. It's very easy for people to travel to hotels and short-term rentals and do a lot of things they wouldn't do in their own home that can have a lot more expensive fixes, especially in boutique hotels. Imagine Las Vegas and all the things that have happened in Las Vegas hotels over the last 80 years. The amount of money it costs to fix those things needs to be accounted for on your underwriting models. Next up, financing. Hospitality CMBS can often require 10 to 13%, 14% debt yields as opposed to 8 to 10% for multifamily, basically meaning they want more margin on their debt. And if you are an independent mom and pop owned boutique hotel and you don't have a large franchise backing you with franchise guarantees or covenants, it can get a lot more expensive to finance your boutique hotels. And if you were doing an industry franchise location. Next up, your comp set. RevPAR is honestly only as honest as the competitive set behind it. It's a very easy number to make hotels look flattering when you're buying and selling them. So digging into numbers underneath the gross rent, for example, in multifamily set, understanding what's going into those numbers is absolutely key. And expense ratios. Hotels have higher expense ratios. Unlike triple net leases, which might have a 5 to 15% expense ratio, or multifamily, it's anywhere from 40 to 60%. Hotels can run much higher to the tune of 55 to 75%. And so someone telling you, don't worry, we're going to run a 40% OpEx, it's not efficiency. It's oftentimes because they're just not accounting for something. And so if their operating expenses look too low, it's usually because something's not being accounted for. And if they show you the underwriting model and they actually have accounted for everything and the underwriting and the OpEx ratio is still very favorable, that's a good deal you should get into. But you need to know what's being left out and what needs to be there. Finally, new supply. Rooms that get permitted or under construction around your comp radius can be a huge threat to your occupancy. You think about it when a brand new strip of land, imagine you're down in the coastal Florida, Miami, and a bunch of developers come in and simultaneously build 10 hotels all within 4 miles of each other. That's a problem because when you start looking at a great opportunity, chances are someone else is as well. And so when you have these boutique hotels, understanding what other people are doing and what is coming on market is a massive, massive, problem if you aren't being aware. Again, what happens if you don't ask these questions? Palm House Hotel, Chicago Convention Center, J Peak Resort, all these situations where money was invested, questions weren't asked, investors were misled, and you have people like the Palm House Hotel operator who raised money from over 88 different foreign investors to buy a hotel, which where that money actually went was to a 150-foot yacht with a mansion. The hotel is never actually completed. So you need to understand, again, just because a deal looks good, hotels in a great location, great amenities, so on and so forth, please verify these things because hospitality projects are capital hungry, they're multi-year, it can be very difficult to verify from a distance, which makes them really ideal for commingled accounts, big spikes and drops in revenue and expenses. So ensure if you're going to invest in one of these boutique hotels, that you can maybe see it, you're able to like an idea of what the financials are looking like, who's running those things. And when you have a really good operator, it stands out, which I'll brag on Rafa for a hot second. Tyson and Rafa did the Boardwalk Boutique Hotel project almost 2 years ago now. They found a great deal. Rafa actually, as a part of the deal, moved to that area, bought a house, and actually relocated there for a period of time. And Boardwalk Boutique Hotel, and again, this opportunity was raised for almost 2 years ago, is going on its 21st month in a row of fully paid preferred returns on time in full, 21 months straight. That's good and that's impressive. Where a project was brought together, people spent time operating it, and they have 21 months of straight full and paid prefs. When a lot of other operators and industries are seeing prefs get cut or sloshed down or completely removed, those types of good deals can exist, and a lot of our investors are consistently getting great updates and great returns off that opportunity. So they can do really well, and you have people in the room like Rafa, like Tyson, who are able to participate in these deals and make them work. So let's talk a little bit about the forecast. So we were talking a little bit about RevPAR growth. U.S. hotel RevPAR growth right now, 2025 was about negative 0.3%. It was the first non-recessionary RevPAR decline ever recorded in U.S. hotel industry. It's pretty crazy. And these numbers are actually coming from two different professional forecasters, the STR Tourism Economics Board and PwC. And two professional forecasters differed, with one projecting 0.6% growth in 2026, one projecting 2.9% growth in 2026. Meaning two professional firms had 230 basis points of difference in their projections. What does that mean? They don't know what's going to happen. That's all that means. And so if you can't predict the future, what do you have? You have strong management, you have a trailing history, and you have the things that make deals work, which is operators who have market expertise and knowledge on what is and is not realistic. So when you look at deals, if the pro forma operates on the high end of these ranges, or for example, if you were brought a deal and you saw that they needed their RevPAR to grow by 3% this year, you might say, well, wait a second, Timberview Capital showed me that some people are estimating that RevPAR is only going to grow by 0.6% this year. Does their model rely on 3% growth to make it work? If it does, you have to understand that they're using the high end of these assessments to make the model work, as opposed to needing only 0.5 or 0.6 or 0.7% growth and everything else being gravy. But the other thing that is not unique to boutique hotels that we need to watch out for is the debt. So this right here is delinquency. And right now it looks stable, but for many asset classes, not just unique to boutique hotels, we see a lot of lenders who have been extending and modifying, but loans aren't necessarily healthy. And nearly 48 billion of hotel CMBS loans come due across 2025 and 2026. And about 30% of all hotels and motel mortgage balances mature in 2026, which is the highest share by property type. A lot of that debt was originally procured between 3 and 5%. Now it's between 6, 7, maybe even 8%, depending on the market. So when we see different loan amounts and different delinquency rates increasing going into 2026 and so on, when you guys go to look at a property to invest in, one of your first questions needs to be, are we getting new debt or is it an assumption? And when does the loan mature if it's an assumption? And can the property survive interest rates at today's market rate? Again, this is not unique to boutique hotels, but the debt clock is absolutely a major concern, especially because you see higher overall rates in this industry for boutique hotels and say other multifamily or self-storage rates. So key risks and how a real sponsor answers them. So first off, when you ask a sponsor about what is the demand and the RevPAR volatility in this market, right? And we're going to have Rafa come in a second and talk about what he did to identify why Boardwalk made sense to pursue as an investment opportunity. But when you're looking at investing in one of these deals, ask about what's the demand look like and what's the volatility in a RevPAR. What you should hear back is, here's the last 12 months of our RevPAR, here's the comp set we're looking at, and here's what happens if that goes up or down by 15, 20, 10%. Operator dependency. Who's in charge? Being able to say, you know what, here's our management agreement, here's how we're compensated, here's what happens if somebody gets hit by a truck or wants out, here's how this works. What about capital expenses, Mr. and Mrs. Operator? Well, here's how we're taking 4% of our gross revenue. We're putting it aside for CapEx. We've also budgeted at least this much dollars amount per key to renovate the property, funded by the raise at the beginning of the project. Fantastic. What about our debt and refinance risk? Our loan is X many dollars at X% interest rate. It matures on this date. Our debt yield is, say, 12%, and the lender only requires a 8%, so we have plenty of margin. And our model does not require refinance. It doesn't require a supplemental in order to hit returns, or if it does, here's how we've accounted for that. Fantastic. What about branded franchise terms? If you're working with a franchise agreement, again, Marriott, Hilton, things of that nature, here's the franchise management agreement term. Here are the costs. Here's the renewal dates. Here's what happens to the property if we lose that or if we go independent. And finally, how concentrated is the demand in this area? Well, demand is right now currently X% leisure, X% corporate, and X% group. And here's what happens if our largest model changes or if our clientele type changes up at all. So, Rafa, can you give us a quick few minutes of when people ask these questions, you're an expert, you know how this industry works. What about the boardwalk opportunity stood out to you that eventually made you want to partner, bring capital into it, and now be able to be at a point where you can successfully say you've been paying investors for almost 2 years straight? Things are going according to plan.
Yeah, so several things, and I just want to say really quick, dude, you're hitting a lot of really good topics. So I appreciate that because when I talk to a lot of people about this, they're kind of all over the place. You're hitting all the right topics here, and to touch on your question here, the Boardwalk Inn, when I first saw this deal, number one, what did I tell you guys earlier? The regulations. I knew that it was in the market and I knew it was a boutique hotel. I didn't have to deal with all of the STR regulation stuff. It was zoned specifically for hospitality. What does that do? It de-risks us immediately because we're actually in an area that allows us to be able to run this as a short-term rental opportunity. And boutique hotels are similar to short-term rentals, but we're allowed to actually do nightly rentals per room at scale, multiple doors or multiple keys in one building. And so with the Boardwalk Inn, the first thing I look at, aside from what market it's at, is the debt structure. So this specific deal, we happen to be able to acquire it with really good debt. We got seller finance on it. We started talking about it. We started working our numbers. And then the second thing I looked at was the market. For boutique hotels, I look for drive to destinations, not drive through destinations. So, two very distinct things. If people are actually traveling to that market for leisure, and it's within a specific area of major cities, that's something that I'm really going to take a lot more time to pay attention to. I knew Carolina Beach was close to a lot of the major cities. I knew that it was only an hour and a half from a lot of major places, and I knew that it was the number one travel spot for the Carolinas in that area. So Myrtle Beach was only about 2 hours away. A lot of people were trying to get away from there and trying to find something a little bit more peaceful, a little bit funner, where they can come with their families. I knew that it was very seasonal, and during the season, it did so well that it would actually cover the off season, and that the off season still stayed occupied at a pretty decent occupancy rate. Then when my business partner brought me this deal, actually, he's like, "Yeah, I have this deal. I think I'm gonna pass on it." I'm like, "Well, why are you gonna pass on it?" And he already had a few boutique hotels in the market. And he's like, "Well, we gotta kind of put the team together. We have to get some funds. I don't want to have to come out of pocket." We started talking, and so I'm like, "Let me take a look at the deal." So I looked at it, and I'm like, "Dude, you're getting this thing seller finance at fantastic debt. Let me look at the rev par." I was like, "Okay, over time with the occupancy and the projection of the revenue per available room that we can make as an average, we would be in a very good position to be able to refi this thing out in a couple of years when that note is due from the seller finance." Now let's look at what the actual capex is. What do we actually have to put into it, and what levers can we pull to generate more revenue? Well, when I walked the property, as we were talking about it, we just went over to the property. I saw a room that was very awkwardly shaped, and I'm like, "Dude, we can totally make two rooms out of this one awkward room. All we have to do is put a door here where this window's at, put a wall in the middle, create another bathroom here, and there we got another room that would generate us an additional whatever number of I don't remember off the top of my head, but I think it was like 70 or $80,000 a year, something like that. I don't remember the actual number. And I'm like, okay, now we have levers that will generate more revenue. And because you got to think of this, and I'm going to just give a quick side note here. A hotel, you can only make so much money in available as a product, and the product is the nightly stays. And if you have 18 keys, 18 doors in this thing, you can only sell 18 rooms per night. There's no additional nights or rooms you could just all of a sudden add. So when you go and buy one of these things and you find one extra room, that becomes a big deal, because now you know for a fact that you're going to be generating way more revenue as a comparison to what it was doing before. And then we looked at financials. We knew it was being mismanaged. That was the first thing. When I looked at it, I'm like, wait a second, what's going on here? They had a cleaning lady being the girl that checked people in. They had no automation. They were still handing people keys. I mean, this was ran very poorly. And I'm like, dude, just on the automation alone, we can lower our costs significantly and be able to generate our revenue with the extra room. This thing was a no-brainer. And so then came the second deal. What do we need to do to actually make it work? Well, we need to put a team together. And I'm like, this is perfect. This is what I thrive at. I know how to put deals together. It's my expertise. A lot of people think that I'm actually my expertise is short-term rentals, and I'm great at that. But I'm actually really good at putting teams together and putting the right people and finding the right people and making the right connections. So immediately I'm like, oh, well, I know Tyson. Tyson's one of my best friends. I trust the guy. He raises capital. Why don't we bring him in on this deal? He can be a partner, right? I have the on. He can raise the capital for what we need to be able to get this thing running. We have for the capex and make sure that we can get this thing off the ground. We have someone that can operate this and be able to do all of the remote management, which was me. I know how to manage all of this with my virtual assistants, my team. Everything can get done automated. I know automations like the back of my hand. And then I was like, well, we have people that are the biggest part, are boots on the ground. Our team that was there, they're already running boutique hotels there. They have the cleaning staff in place. They have the maintenance people in place. They have the linen company in place. All of that came together, and I'm like, man, this is absolutely no brainer. We got a fantastic team together. We know for a fact we're going to raise the revenue on a yearly basis. We know for a fact that we can raise the average daily rate, or the RevPAR, and we know that it's going to cash flow very well, and we're going to be able to have a lot of reserves, because the debt that we're getting now is going to allow us to save a lot of money and pool a lot of money, be able to pay our investors without a problem, and be able to have enough money in the bank to be able to refinance this thing once it's ready to go. Now, I will say this, the biggest thing, that if you guys are all looking at boutique hotels, and the first question you need to ask is, what's the debt structure that they're getting, and what's the plan to be able to get out of that debt structure. If the operators don't have a plan for you, you can get in a lot of situations. Now, I do want to touch a little bit on something specific, because, this is something that I look at in every market, with short-term rentals and boutique hotels. So, for example, in the Joshua Tree deal, I love that market, because that market for short-term rentals is 100% short-term rentals. That market would not thrive in any other aspect. The entire city makes money from people traveling to that town. It's a tourist town. For the boutique hotel in Carolina Beach, it's 100% a tourist town. That entire town thrives on people traveling to that town and spending money and staying there and doing the fun things there. What does that do? That solidifies and de-risks your investment instantly, because you know that you're going to be able to operate in these markets for a very long time. They're not your typical markets, because they allow you to run this type of hospitality business, and they actually set their laws, rules, and regulations for the hospitality industry. They're helping restaurants get permits faster. They're helping people build faster. They're allowing you to make changes faster, because they want you to be able to provide a better service so that people can continue coming to their town and spending money. With the short-term rental aspect things, it's one of the reasons why I also stay away from major metropolitan areas now. For example, New York, Chicago, all of these, Los Angeles, all of these major cities. Their number one priority is not travel and hospitality. Their number one priority is the people that live there and making sure that everybody's happy. So I kind of stay away from those markets. So for the boutique hotel, Donato, it was a no-brainer. It's in a fantastic market that's pro um, boutique hospitality, that is a travel to destination, and we have the perfect team to put the deal together. And I mean, as our track record shows, we're going into. It's funny, I didn't even know this that you said earlier, because once it starts running and everything's flowing smoothly, you don't look back. You just make sure that the numbers are moving in the right direction and that everything's going well.
Fantastic. All right, everyone. Again, we have a set of questions you can all take a photo of if you're interested, for what to ask the next time that you are considering a boutique hotel investment. You can go ahead and grab a photo of this. Again, this webinar is being recorded, and you'll have the ability to come back and look at the slide again and again. before you choose to participate in your next boutique hotel investment. So I'll leave this up for just a few more seconds, and then we'll go on to our next slide here in 3 and 2 and 1. And we have another set of questions for the property in the numbers. Again, talking about demand, supply, pipeline, revenue assumptions, expense loading, expense ratios, capital plan, and downside protection on things like revenue shifts. Go ahead and grab a photo of this when you're ready. I'll go ahead and leave this up for another 1, 2, and 3. Perfect. And a couple key vocab terms just to make sure we're on the same page. GOP versus NOI, talking about gross operating profit before fixed costs. And then your NOI is after the management fees and reserves, but before the debt service. Your FF&E reserve, furniture, fixtures, and equipment. Furniture, fixtures, and equipment is your replacement reserve, which is the money that keeps the hospitality asset sellable. Your PIP, or property improvement plan, which is oftentimes at the franchise level can be a brand mandated renovation. Debt yield is just the NOI divided by the loan amount, which is how much cash the property throws off per dollar borrowed. So if you have a loan of $1 million and NOI of $100,000, you'd have it's about 10% debt yield. So higher debt yield is better, means you make more money relative to your debt. And your comp set is just the competing properties as a hotel benchmarked against that you're benchmarked against. If you want to look at Airbnb, short-term rental, VRBO, or boutique hotel numbers, there are a couple different resources you can leverage for these things, like AirDNA, local planning department, CoStar and short-term rental benchmark datasets, PwC's U.S. hospitality directions datasets, SEC Edgar, and SEC IAPD and FINRA broker checking to do background checking on any potential operators that you're considering investing in for these opportunities. Finally, got a couple sources here, but we're going to go ahead and turn it over to our Q&A section. If anyone has any questions, comments, concerns, we'll stay on for a few minutes and answer anything that you guys might have on the top of your mind. Besides that, I will say thank you, Rafa, for coming on and spend time with us this evening. Everyone, I appreciate you guys being here tonight to come and learn about the latest installment in our short-term rental and boutique hotels for the How to Catch a Bad Deal series. And Rafa, thank you for sharing your expertise.
Yeah, thanks for having me. This is great. I can talk about this all day.
Absolutely. All right, guys, any questions in the chat or Q&A, please feel free to put them in there now. We'll go ahead and let this roll for a few seconds here. Unless we've done such a good job, there are no questions right at this moment. Um, let's see here. We are going once, and I'm seeing going twice, and I believe we are sold. Okay. Well, then, with that, guys, no questions, comments, or concerns at this point. Thank you all for being here tonight. Give you back the rest of your evening, and please look forward to checking out our next webinar in our How to Catch a Bad Deal series coming up next month, where we'll announce the latest asset class to get the under the magnifying glass look. Hope you guys learned something. Hope you guys learned something tonight. Have a great rest of your evening.